This is our last meeting for the year, and I'm sure yet another productive session in front of us.
Yes.
Larry, over to you. Well, now we have to take roll call first. Here. Joel's office.
Present.
Public Advocate's office. Here. Borough President Manhattan.
Here.
Borough President Brooklyn.
Here.
Borough President Queens.
Yes.
Borough President Staten Island.
Present.
Borough President Bronx.
Here.
National Brotherhood of Teamsters. Here. Transport Workers Union.
Here.
Council 37.
Here.
Okay. Thanks for all coming early. It was a busy day today. I guess I have to turn it over to Thad. Eric Eve would like to be here, but he's on vacation today. So let me turn it over to Thad.
Thank you, Larry. So, as Larry mentioned, I have a statement from our first Deputy Controller, Eric Eve. I want to thank you for the opportunity to provide the Board with an update regarding the pension investment reform proposal. Despite ongoing efforts to brief stakeholders, including our office's recent presentation to the Board in November, there remain some public misconceptions regarding the proposal. Accordingly, we would like to assure Board members that there's been no changes to the Board agreement in principle that was announced in October between the Controller, the Mayor, and Wrigley. The details of this announcement remain available on the Controller's website at controller.nyc.gov/ERI-NYC. Unfortunately, due to a long-standing scheduled vacation, I am unable to join you at today's meeting, but would welcome the opportunity to provide a further update to the Board. Thank you very much.
Well, I would invite him to the next investment meeting then, if we can, because there's been no details provided to us at the last meeting beyond anything that was formally put on the website. So, to say that nothing has changed means there's no details beyond what was announced 2 months ago. So he's more than welcome to come to the next meeting.
I will convey your invitation. Thank you.
And everybody's entitled to a vacation.
That's good public policy.
Absolutely.
Thad, for the record, I would just remind Mr. Eve that we had a whole list of questions that we were concerned about. One of which was the board members, how many board members there would be, who the board members would be, where they'd come from, how they'd be appointed, who they'd be accountable to after they were appointed to the board. We also asked Mr. Eve for, after he made statements about there being fraud and corruption somewhere in the pension funds, we asked him for some evidence of that and how that would be avoided in the new board. And I personally also came to the conclusion that if you wanted to avoid any political influence on this board, then the mayor and the controller should not have any appointments to that board under the rationale that you're using for this new board. And we will look forward to Mr. Eve commenting on that. And there are just a whole bunch of other, we have that list of questions there. It's included in our letter that we sent to the board. And when Mr. Eve comes to the next board meeting, we appreciate the responses to all of those questions.
Al, I'm so happy to convey that. The one thing I might question is actually I don't recall any statements about corruption or other things that were made. Someone convey your worship have the questions that were raised in your letter responded to. But again, I don't recall any statements made about corruption.
I think the statement Mr. Eve made at the time and has continued to make, because I've been at other meetings where he's been present, is that by doing this board you will avoid fraud and corruption and political influence. Now, the question that was asked was, where has that ever happened, particularly with the NYCERS boards or with the other boards? So if it hasn't happened, I don't know what he's trying to avoid. I think that's the point of the question.
And certainly convey your thoughts and back to the letter that the board members sent us.
Yes, there's also some differences from the press conference, which was relying on the endowments Harvard and Yale, and he said that actually was not the template that was here. And also that in terms of the returns, that the returns might not yield 1 or 2% above what they are presently. So that was a difference from what was said earlier. So there's some things that need to be cleared up.
Although I haven't been at the meetings, but it's been reported to me that Mr. Eves is now telling people 1, 2, or perhaps 3% is something that could be available if we made this change.
Sky's the limit.
So I have some question about Square, and again, I wasn't at the meeting, so it may not be accurate.
Actually, I was at a meeting where that was said, so.
Well, then how does he square that with what he told the board? You can't predict 3% and tell the board, well, there's no way to predict. You can't do that, in my opinion. Or you shouldn't do that. Yes, you can.
I'll convey your questions, Mr. Eve.
If I may, if there are meetings going on, I'd like to know about them. Since apparently everybody else at the board has had meetings on this issue, but it seems that the Borough President's office was...
I don't think they were nice.
There's been no meetings. These are other meetings that
They're not NYCERS meetings.
Well,
Not NYCERS meeting.
not nicer meeting, but meetings that other people have attended that discussing these issues
John,
which
I
involve
was at the borough president has a representative on the BERS board,
me. Yes.
and I attended one of those meetings.
Okay.
Where
John, I think-
Mr. Eve made a presentation.
I think that was a reference, John, to the first meeting last week.
Okay. Well, I just like to be kept informed and keep involved in the process. It's something I made a point to ask
Representative on
me.
the first.
Understand?
Any further questions or
Everybody on
comments?
PDP is a member.
Thank you, Ben.
Okay, so that gets us to the quarterly performance review that you all should have. Again, these are numbers through September. We're going to try to go through these fast because we have the October numbers to go through as well, so these are old. I would also tell you before you start, Martin, September was a month that was bad. You'll see the October numbers, October was good. So, have at it, Martin.
Thank you. So, and of course, Larry, along the way, has been going through the numbers. And so last month, we showed you the September numbers. But as Larry mentioned, September quarter was a quarter of upheaval in the financial markets. There were a number of concerns that went on, serious concerns for investors that weighed on their decisions. The continuing sovereign debt crisis in Europe. Back in the summer, there were slowing economic signals for the U.S. The worry, if you remember, from late July, early August, over the debt ceiling crisis and possible default, and then, of course, ultimately, the downgrade of treasuries that occurred. All of this created uncertainty in the market, increased volatility, and had a negative effect overall, and increased volatility in risky assets, but we saw a flight to quality. There was a series of risk-on and risk-off trades. Overall for the quarter, the U.S. market as measured by the Russell 3000 was down more than 15%. Large cap did come out ahead of small cap, but still down double digits. For the non-U.S. markets, the developed markets were down even more, and the emerging markets were down more than 21%. In fixed income, the classic flight to quality, treasuries were up, as you'll see later on, 13% for the quarter. Any quarter that treasuries are up 13% is a sign that there's a flight to quality. Investment-grade fixed income did well. Even spread sectors, not quite as well as 13%, but we do have some positive numbers in the report. So overall, if you turn to page 7, you'll see that the fund, the NYCERS overall, lost 9.55%. That's all the way on the left. And the market value was now at $37.3 billion. The performance was ahead of the benchmark by 58 basis points, and I'll get to that in a moment. For the one-year number, it's still positive at 241, also well ahead of the benchmark. 3 years slightly behind the benchmark, but positive at 433, and longer term, you see the numbers there slightly ahead of the benchmark. The next 2 pages show on the top the asset allocation pie chart where the assets are invested. So on both pages, they're the same. The difference between the 2 pages show what the overweights and underweights are versus the old asset allocation and the new asset allocation, and we'll be in just a few moments talking about these rebalancing ranges. So for instance, you'll see under the old policy we're underweight U.S. equity. Under the new policy, since we reduced U.S. equity, we're overweight U.S. equity. you look at page 9, we're underweight the increase in emerging markets, we're underweight hedge funds, and in pink on the right side, we're now underweight opportunistic fixed income because of the increase to 5%. You'll also notice that we had 8% cash. We are going to address this a little bit later on and describe to you how that cash has been deployed and how it will be deployed. That cash has been significantly reduced since this date. In fact, you'll see the October number, and we can give you where November and December will be.
Why don't you tell us now?
Larry?
Can you just wait till we get to October because to start with a lower number? Okay.
Yeah, we'll go
10
into
minutes.
detail.
Hold the suspense for 10 minutes.
So turning to page 10, the quarter ending September, of course, was negative. But if you see, we did outperform by 58 basis points, and most of that's attributable to the allocation effect. The allocation effect refers to how the system did because we were over underweight versus policy. Managers were roughly flat, slightly positive versus their individual benchmarks. A big part of the allocation effect, in fact, was the cash. In a down market, cash is a very effective buffer for the portfolio, and it did what it was supposed to do in the quarter, and that's why we were ahead of the benchmark. So it did what it was supposed to do. Of course, in an up market, cash will be a drag on performance, and that's why, Larry, we will talk about how we're redeploying the money. Obviously, it's a very effective tail risk hedge, and Pat, we will go through the specifics. The one-year number, similar story, although we now have positive numbers, although they would drag down, they were stronger positive numbers before that quarter. Larry will have the good fortune of telling you about a pleasant October set of returns. But the managers did well, and the allocation effect also did well. Three-year numbers on the next page get smoothed out. I want to draw your attention to page 14 as to how NYCERS did versus other large public funds in this very volatile and uncertain time. For the quarter, that's all the way on the left, NYCERS minus 955 was in the 71st percentile, so it's in the third quartile. That's not where we aim to be, but as you know, the new asset allocation reduces some of our equity risk, so over time we would expect that when the equity markets go down, we won't go down quite as much as we had before. If you look at the annual returns in the middle of the page, 1, 3, 4, 5, we're pretty much, for the longer term periods, either right at the top quartile or in the second quartile, and for the one-year number in the 46th percentile.
Martin, before you move off the peer group returns, I just wanted to remind Callan and Mark that the board has requested the detailed report on the peer groups adjusted for some of the things you talked about in prior meetings. So maybe we can sequence that in whenever you have January year-end numbers.
Right. Well, I believe the discussion we had was at beginning with the end of the calendar year, at which point the asset allocation would be in effect. We would begin a revised measure of all of that, and on probably a semi-annual basis, report to the board on that and our sort of top-down view of overall performance. Generally, that would probably, depending upon the schedule of the meeting and the reports that we get, would probably be at the February or the March meeting.
Great, thank you.
And now I'm going to turn it over to Seema for comments on the equity portfolio.
Thanks, Martin. So if you turn to page 18, this shows the domestic equity returns versus the benchmark, the Russell 3000. And as you can see in the trailing 3 months, we're a bit behind the benchmark, as well as in the trailing 12-month period, just a bit behind the benchmark as well. If you turn to the next page, this goes through some of the details behind those numbers. And I'll point out just a couple columns here, the index return, the actual return, and then the difference column. Earlier, Martin made comments about how the markets performed, the equity markets performed in the quarter. You can see there that small cap did worse than large cap in the quarter. And while NYCERS is about 80% passive, you can see in the difference column a couple of the active buckets I'll just highlight. So small cap active, slightly behind the benchmark there. That was really Daruma, although they have performed quite well for you in the longer term. Another point to make on the small cap fundamental index, RAFI, one of your managers, was a bit behind in the quarter, but again, still doing well for you longer term. And then finally, toward the bottom there, under emerging managers, about 160 basis points behind the benchmark. Each one of them, you have 4 of those, had a bit of a tough time just in the quarter. If you turn to page 26,
Just when I'm driving this is just a reversal in just which sectors are doing well, given the market's up, down, is that?
pretty much, I mean, so it's been small versus large, and then financials, those that were more weighted toward financials did worse than others. But, I mean, no real trends that I can tell at this point. So if you turn to page 26, this is the international equity allocation. And the pie chart down there below, I'm just going to refer to this darker red piece, which is 27%, which is the emerging markets piece. We've talked about this a lot. This is a growing piece of the portfolio, and we're going to talk about emerging markets more later in the executive session. If you turn to the next page, that shows you the EFA market returns in the portfolio versus the index. And as you can see in the trailing 3 months, a bit behind the index, similarly in the trailing 12-month period, although in the trailing 3-year period, actually outperforming the benchmark by a little bit there. And in this case, the value managers have been doing better than the growth and the core managers for at least the 3-month and the 12-month period. But again, I don't sense any long-term trends or anything like that in this part of the portfolio. So if you then turn to page 32, this goes through emerging markets and the returns versus the custom benchmark. And basically in the trailing 3-month and the trailing 12-month, you can see we're just about near the benchmark, a little bit behind, and then slightly outperforming in the trailing 3-year period. But again, we're going to go through emerging markets in more detail in the executive session.
Were we going to add a page like page 19 for the international section?
Yes, and we did that at the other boards, and I apologize, it didn't happen here.
Okay.
Yeah, we'll make sure that happens next time.
So going back to fixed income,
Oh yes, back to you, Martin.
just want to make sure you're done. On page 36, this is the pie chart that shows your overall exposures in all fixed income. $12.1 billion, the largest slice is the investment grade program, a little bit more than half of the portfolio. Again, you'll see in, I'm not good with colors, in purple is the cash, and we'll address that, Pat, a little bit later. Breaking down the largest program, which is the investment grade Core Plus 5 program, is on the next page, 17% of the assets. You'll see under the chart with the column labeled over underweight, we were underweight treasuries and agencies, no void spread sector. Treasuries and agencies returned 13%. So the fund had a negative allocation. It says a positive allocation effect. That's a negative allocation effect. The managers overall in each sector mildly underperformed the benchmark. You'll see also in October, in some cases that reversed. When the market came back, the market obviously is oscillating between fear and then goes back to amnesia, and then the same news story, and then it's back to fear again. And Larry will talk about October. Taking it all together for the Core Plus 5 program, on page 38, the return, some of the few positive returns you're going to see this quarter. The fund for the Core Plus 5 overall saw a 3.96 return behind the benchmark of 478. 1-year return of 617 was 8 basis points behind the benchmark. The 3-year number is quite strong at 1025, and even with the underperforming quarter was over 100 basis points ahead, and is ahead for the longer periods, right in line with what we expect. I've drawn your attention to this for several quarters, and I'll do it again. The column or the chart on the bottom below the bars show the volatility of the performance, and the volatility of this performance that was achieved is with a 4 to 5% volatility. Historically, it's in the 4s. Recently, there's been a little bit more, but a little bit more here only gets you to 5% volatility.
Can I ask you about the returns on page 37?
37.
Treasuries?
Yep.
Those are just book values, or are
No,
we
mar-
selling them?
Those are market values, so it's
They're market values.
They're market
We're not, is there a reason we wouldn't be selling them?
treasuries and, well, we're underweight treasuries and agencies.
Yeah.
We're underweight, so that, since treasuries and agencies
Yeah.
in the flight to quality did 13%, that underweight,
No, but I mean,
Hurt overall.
okay, Lydia, I'm just trying to, we're making these kind of returns because we have treasuries with higher coupons, right?
we have treasuries with, treasuries with even low coupons do well because of duration, the sensitivity to interest rates. And in fact, as the interest rates on the coupon, say 10-year, you have a 10-year with a 7% interest rate
Right.
with 10 years to go, and you have a 10-year that's newly issued with 3%
Right.
coupon rate.
It's-
There's a higher duration of the 3% rate, so as interest rates go down, you actually get more bang for your buck with the lower rates. Now, the coupon that you collect every 6 months is lower, but as interest rates move, it's a larger move in the market price.
Okay.
TIPS returns are on page 39. These are generally treasuries. There are some agencies and non-U.S. inflation-linked securities in here, but it's vastly, the vast majority is, the overwhelming majority is U.S. Treasury inflation-linked securities. The returns were positive at 480 ahead of the benchmark. For the year, the returns were 919 behind the benchmark, and you see the returns going out 6 years. We're going to be legging in, as you know, the new asset allocation increases TIPS. We're going to be legging into that. Right now, TIPS prices are very expensive, so we'll be looking for a time when TIPS move back, and then we'll go into TIPS. TIPS have real yields that are negative out to 12, depending on the day, 10, 11, 12, 13 years. High yield had been a high flyer. For the quarter, the return was negative. High yield does have equity sensitivity, but as we would have expected in a down equity market, it doesn't go quite down as the equity markets do. It's an over-the-counter market that's a dealer market, and liquidity dries up very quickly. So the returns were minus 529 behind the benchmark of 399. For the year, it's still a positive number, pretty much flat with the benchmark returning 310. But if you look at the longer-term results, they're very good, including the 3-year number well ahead of the benchmark. We are presently in a high-yield search, and we'll have those results for you in the coming months. Convertible bonds are on page 41. 1% of the fund is in there. Convertible bonds, I mentioned high yield has equity sensitivity. Convertible bonds have even more. And so you have a worse negative return, but it was ahead of the benchmark by the tune of 139 basis points. The 1-year number is roughly flat, slightly negative, but it is ahead of the benchmark, and we have a 3-year number returning 809 behind the benchmark. Page 42 is opportunistic fixed income, and we'll be talking a little bit more about this in the specific managers in the executive session. The return was minus 733. Of course, that's behind the benchmark, but the 1-year number and 3-year number are well ahead of the benchmark. This underperformance has to do with some, as you see in private equity and real estate, there are some lagged results that we get quarterly numbers for. The next 2 pages show developing and emerging manager returns. And I'm going to turn it over to Kathy Martino to talk about ETI program.
Good morning. Your ETI portfolio is a steady performer, and while it underperformed its custom benchmark for the shorter periods, it did outperform net of fees for all of the longer periods. Again, that's what we look for here. Your collateral benefit report starts on page 8. There wasn't a lot of, there was some activity, but not a lot, but I did want to draw your attention to this chart of the AFL-CIO housing investments in New York City, which is a very nice graphic. It's on page 11. They've done quite a bit and some nice projects. We hope to actually create a chart like this that shows all of your ETI investments.
Yeah.
Yeah, that was on page 11 that I was referring to. So with that, I turn it over to Ron.
Okay, great. Still in the board book, real estate highlights for the second quarter for NYCERS real estate portfolio, page 18. positive result that quarter, 4.9% for the second quarter on a net basis. That is a modest outperformance to the Odyssey index of 4.4 for that quarter. The market value of the portfolio at the time was $1.3 billion. We have about $500 million, $500 million in unfunded commitments, and together that results in $1.8 billion. AUM invested in real estate at this time for NYCERS is 3.2%, so we're kind of a little bit over that 50% mark. There were some comments already about the economy. However, it has impacted real estate as well as other asset classes. And in light of the continued turmoil, the real estate recovery is stalled at this point. It's in a kind of fragile state. In terms of the real estate fundamentals, I would say that there is a flight to quality, which is a theme that you've heard before. There are, keen interest in acquiring properties at Main and Main in gateway cities. There's also very, very little new supply coming on because very little construction in commercial real estate today. And in turn, there's been a modest demand for the space that is available, which is impacting vacancies in a good way. Vacancies are lowering. And that kind of sets the table for growth in income, and that actually has happened in the residential sector. So that's good things for real estate in terms of the performance in the near and extended periods. We already talked about the quarterly performance. For the 12-month period, you'll see that NYCERS is ahead 720 basis points for the 12-month period. However, for the extended periods of 3-year, 5-year, and since inception, we're probably more bumping along the index in terms of performance in the long term. Moving on to page 20, just some checks against the portfolio composition of the portfolio that's consistent with the IPS. The real estate allocation is at 6%. It was reaffirmed in May by the board during the approval of the asset allocation, and that results in second quarter for a potential size of a $2.5 billion real estate program. In terms of the strategies that will be pursued, you know that we're pursuing core strategies as well as non-core strategies. Emerging managers also fits within that non-core bucket, and the permissible range is 40 to 60%. And as of second quarter, the NYCERS portfolio was 47% core and 53% non-core. And as I mentioned before, that non-core also captures the emerging manager activity. So we have at this point 38 real estate investments with 26 separate managers. Post-quarter, we closed on our commitments to Taconic, that's $70 million, and also the re-up with Carlisle 6 for another $70 million. Both are indicative of us placing capital with existing managers that perform well, and also it represents an outreach to identify new performing managers, particularly those that are operators. I also would like to note that in your Tishman portfolio, post this quarter, Tishman sold Gotham Center in Long Island City at a nice profit, and there was a $20 million distribution to NYCERS that was made in November. Moving on to page 21, this is basically just a report card, a compliance report card on in terms of whether or not we're complying with the risk metrics that we set forth in the investment policy statement. We talked about in terms of benchmark that there is an underperformance at the 5-year hallmark, but it's slight. Portfolio composition is good. All the other areas we are in compliance. And also on the last page, it just shows the portfolio. Page 23 shows how the portfolio is diversified by property type, and also at the bottom by geography. At this point, we have an international exposure of approaching 6%. So we can talk about specifics later on, but if you have any questions about what we just reviewed, thank you.
Okay, and with that, we're going to switch over to private equity, which is not in your book. It was a separate handout. So the private equity portfolio, just to touch briefly on the background here. Yes, it's on everyone's.
We have extras here if you don't find
I hand them out to everyone, so everyone should have them on their desk. Just for reference, so private equity, the allocation of the asset class in June of this year was increased from 5 to 7%, giving us a pacing today of roughly $500 to $750 million, and it's put the allocation of the asset class today at slightly above 7.5%. If we look at the overall performance, portfolio as of the end of the second quarter is 9.2%. From a benchmarking standpoint, it's underperforming our benchmark of the Russell 3000 plus 500, as well as the Thomson upper quartile benchmark. What I would mention is, as we've talked about this before, but in the first quarter of next year, we are going to update the policy statement, and with that, we're going to have some further discussions with the board about possibly realigning the benchmarks. For a quarterly basis, the portfolio returned 3.9%. From an allocation standpoint, the portfolio, just by way of reference, it's targeted between 60 to 80% buyout. We're right in the center of that at roughly 71%. Venture capital, which we've talked before, we've now gone from venture capital to growth, targeted 10 to 20%. Again, we're right in the middle of that at 11%. The last two buckets, distress and mezzanine, and the secondary fund of funds and co-investment bucket, again, right in the middle of the targeted ranges. From an overall portfolio standpoint, clearly moving in the right direction. If we look at the first quarter versus the second quarter, returns increased from 8.7% to 9.2%. And we'll talk a little bit later in the presentation, but what's interesting about it is when you look at private equity, the one-year returns, the three-year returns, that's really not the best place to focus. The best place to focus is in the 10-year returns and the since inception returns, where the delta between the returns of the portfolio and the benchmark continues to decrease.
Terry, did we, I remember clearly the shift from venture capital to growth in that bucket, but did we talk about decreasing the 10 to 20 and shifting that to secondary somewhat?
So what we've talked about doing, we actually haven't gone from bucket to bucket. So what we're going to do in the first quarter for the policy statement, what we've talked about doing is actually making the buckets a little bit more defined because they're very broad-based. So effectively we have buyout, we have this venture and growth, and the balance is really other. The portfolio does not have a lot of mezzanine in it, does not have a lot of distress, and frankly doesn't have an inordinate amount of secondary. So what we're going to propose in the first quarter that we'll distribute to the trustees is to really give a little bit more of a focused target for the individual buckets so people get a better idea of where the portfolio stands. Because too much of the portfolio is in this bucket that is just, for lack of a better term, is other. So to try to make it a little bit more clear and concise. So we think that will help going forward. If we look at the overall portfolio from a multiple standpoint, the multiple increased from 1.25 to 1.28, so clearly moving in the right direction there. During the quarter, didn't close on any investments, but again, because we are now in December and we are touching on the June information, what I would mention is the system has closed on 6 fund interests, which aggregate approximately $615 million. Last few things I would mention would have to do with the contribution and distribution. So in the first quarter of last year, distributions outpaced contributions. In the second quarter this year, contributions slightly outpaced distributions, so moving in that other direction. And in the third quarter, this is a little bit of a preview here, contributions again have outpaced distributions. Last few things I would mention is if you look at on page 7, which is the overall returns of the portfolio, spread between 1, 3, 5, 10, and since inception. And as I touched on before, the delta between the overall returns of the portfolio and the benchmarks, for the 1 year, negative 16.8%. Again, private equity is a long-term asset class, so there really is no liquidity after 1 year. But if we look at it from a 10-year or since inception, 10-year underperformed the benchmark by 1.8%, and since inception, 2.1%. Last thing I would mention is page 8. If you look in the bottom corner, which is a graph, which is the portfolio done by public versus private. And one of the things that's interesting here, if you look at the first quarter and the second quarter, and frankly, starting in the end of the fourth quarter of 2010, you'll see an increase in the public portion of the portfolio. And there's really two things that go with that. As the NYCERS portfolio continues to get more seasoned, so there are more either IPOs or companies move towards liquidity, you will see a greater portion in the public versus private. It's fair to say in a more seasoned portfolio, you will be probably somewhere in the 75% private, 25% public, because again, it's important to note when companies are, when the IPO market is open, private equity managers take companies public, but they don't necessarily sell on the IPO. So there's just more liquidity in the portfolio. So when you look at the duration of this portfolio, it's fair to say in the upcoming quarters, assuming the IPO market opens up again, you will see a larger portion of the portfolio in the public sector. And if there are any more questions, I would turn it over to Larry.
Okay, that's the quarter. Let's go to the monthly. We can go to October now. Yes, ma'am.
Alan Howard needs to be in at 10. Did you want me to do the review of it before he comes in?
He's just going to have to wait.
He's going to
We
leave.
have to finish it.
Okay, he's going to leave, just so you know.
Okay, so we're going to go through this reasonably quickly. If you skip all the economy charts, basically the economy is muddling. There's 20 different graphs to show you that it's muddling, but it's muddling. Therefore, the key chart I would tell you is page 21. It's VIX. So it's the continued high levels of volatility in the equity and debt markets, driven by any time Mrs. Merkel smiles and Mr. Sarkozy goes up. When they frown, it goes down, and they do that on a weekly basis.
She smiles?
Sometimes. But it's, Europe is having its issues. Every time they think they're going to get together, they don't. So talk about muddle. This is a major, major muddle, which is overwhelming a variety of things in the market. If you go to page 22, you see the U.S. yield curve. The white line is the current yield curve. It's coming down. The Fed has Operation Twist. They want to come down, and people are just piling into U.S. governments whenever they get worried about what's going on in Europe. So today, the 10-year Treasury is at 1.85%. The 30-year Treasury is at 2.82%. Both of those are sort of ridiculously low in long-term, in more normalized periods. If you jump to page 24, again, you can see the spreads blow out. It's the yellow line. It's the high-yield spread. Prices are down. Good time to buy. I'll get back to that in a second. But people are shying away from risky assets, and they want more conservative assets. If you flip over to page 26, the blue line is where corporate profits are in the U.S. Corporate profits are recovering nicely. The problem is a lot of it was through layoffs. They're not rehiring because of the uncertainty in the U.S. economy as well as in Europe, although the U.S. economy is, I would tell you, muddling upward a little. But there are grave worries about what's going to happen in Europe in the first quarter and the rest of next year. Consequently, stocks are reasonably cheap on a long-term basis. You can see the Russell 3000, EFA, and emerging market indices. If we jump to page 29, you can see how the volatility has bounced around. Again, I would tell you to go to August, when things were kind of percolating along reasonably normally, and then all of a sudden, lots of volatility, lots of spread differential between U.S., EFA, and emerging markets. So it depends on what month we look at. We just looked at September, a bad month. I'm going to show you a better month in a second. If you jump to page 31, you can see where NYCERS value was at the end of the year. At the end of October, it's about $39.7 billion. If you jump for a second now to page 36, and you look at the column on the far left, In the month of October, the U.S. indices were up 10 to 13%. European indices were up again 10 to 13%. High yield market was up 5%. These are ridiculously up numbers for a month. Maybe you get that kind of action in a year, but this happened in a month, and it came off the month we just looked at the end of the first quarter, which was down about the same amount. So it's down and bounces back up. So as Martin said, it's a good time to be in cash. I'll get to that in 1 second, Pat. But then if you jump to the next page, 37, you see November. Kind of not much going on in the U.S. markets, even though there's a bunch of volatility, but Europe and international is still down another 5%. So again, lots of volatility. Our managers are doing as good a job as they can, but it is one choppy market all over. So if you come back to page 33 then, recall that we're moving from page 33 asset allocation to page 34 asset allocation. So again, Martin had 8% cash at the end of September. End of October, we have 6.7% cash because we're slowly migrating. Since then, we put in November and December, which you don't have, but I want to get the board up to where we are. We've added in each month 1% to high yield, so that takes 2% off of this number. A quarter of 1% to emerging markets. So now we're down to about 4.5% cash. We're going to talk about hedge funds later today, which is about 1% more. And we're starting to fund our opportunistic fixed income, which you may recall we've allocated about 3% opportunistic fixed income. It's starting to get funded, probably a half of 1%, hopefully by the end of the year, maybe a little less. So when you add all that together, around the end of December, we should be taking this 6.7 down to about 3%. So again, we're moving into this new asset allocation. You'll see these buckets slowly get in the right spots. Some of these things take time. Moving direct into hedge funds, it takes time. And the opportunistic fixed income, again, we've allocated about 3%. So if you look at this chart on the bar chart, it says minus 4.1% to a target of 5. We're already at 3.5, Martin?
Based on what's been improved.
Right. So this is really this is a combination of documenting and then funding. So that'll almost naturally drift up. The cash is coming down. The hedge funds will be moving up shortly. So we're kind of repositioning the portfolio in these complicated times. And again, I think we did a very nice job missing a lot of the risk while we're repositioning. So we're kind of legging our way into these things. But then we'll be back to being invested, so that if big downdrafts come again, we'll have seen how some of this asset reallocation actually helped. But again, as our investments go up, as Martin said, when the markets go really down, if you have a lot of cash, you don't go down as much. It won't go up as much, but we didn't miss very much in October and November because the markets kind of meandered along. So I think we'll be working our way toward this new asset allocation. Again, it was designed to be done over 12 to 18 months. I'm very confident we'll get that done in 12 to 18 months, and we're trying to leg our way into things that the board approves over time. If you go to page 38, you can see all those good numbers in October translated into, we were up about 6.5% in October. So again, great month. Coming off of a lousy month in September, so the fiscal year to date is down about 4%. Again, all in all, given all this choppiness, I would say that's pretty good shooting. It's migrated down a little bit probably in November because of the European results, so if I had to guesstimate, I'd say we're down about 5% through November, early December. Again, it's difficult making money in these kind of markets. Most of our managers have done what they're supposed to do. Some are over, some are under. It's really hard to score people on a monthly basis, particularly with these kind of markets. But again, I think the portfolio is moving in the right direction. Any questions? Okay. Thank you. So we have a manager waiting outside that has to go. He came from out of the country, and he has to leave to go back out of the country. So if you want, we can stop and come back to this. I would tell you he's a terrific guy we should take advantage of while he's here. But if the board would like to stay in public session, we'll miss him and we'll have one of his seconds to talk to. But I would tell you, we should take advantage of him being here. It's up to you all how you'd like to do it.
Larry, I reviewed materials on Brevin Howard, and I have some questions
You should.
I'd like to discuss.
Yeah, he's the right guy to talk to.
Actually, I'd like to discuss that internally.
Yeah, I thought we would before we bring him in, but if we go through this asset allocation, we'll definitely lose him.
Okay, so why don't we go into executive session to discuss this manager and then go back into public session?
Perfect.
So
Okay?
motion to move into executive session. Any opposed? Please turn off the cameras.
We are halfway through the day, and I meant at the beginning of the day, I was kind of hoping I'd be able to remind people Bud Palekia, who I introduced at the September meeting, has been sitting quietly on the back seat, but has been part of all of this work also. At the September and the November meetings, we had sort of gone through a process of discussing the issue of setting up rebalancing guidelines, helping to determine where, in fact, assets should be held, especially as they're being used to fund, ultimately, more illiquid asset classes. And we've evolved through a process through September and November into what we think is perhaps the final updated document, perhaps for approval by the board, that we handed out today. The discussions that have taken place really started with some work on our part, and then through the discussions with the board and BAM into the document you see in front of you. Much of it we have talked about and reviewed at the prior meetings, but I thought what may be worthwhile is to just very briefly take the board through the important points that we had previously talked about, but then also comment specifically on some areas that were still open following the November meeting. So the document itself is a 5-page document, and I'll just refer you to a couple of things. We had in here 4 different questions. So just very briefly, number 1, which was the issue of the division of non-U.S. equity assets between developed and emerging markets, really I think is an issue that we had talked about at the previous meetings and had previously been decided based upon discussions between BAM and us, that the allocation between developed and emerging markets would be a total of 10% to developed markets and 6.9% to emerging markets. That, in fact, was what was shown in the October allocation and market review that Larry reviewed earlier. So this was a recommendation that had been made last time at the last meeting, and we're continuing with that proposal. Item number 3, which is the rebalancing ranges that are being proposed, was really at the heart of this document. And if you take a look at the very top of page 3, these rebalancing ranges were ones that we showed back in November when we discussed this. And the rebalancing ranges really are meant to both preserve the integrity of the asset allocation that the board adopted, but also allow for reasonable ranges around those allocations in order to allow for a certain momentum in the markets to take place, allow some reasonable level of movement around assets, but again, coming back to the issue that by and large, you want to maintain the integrity of your long-term strategic plan. And so the rebalancing ranges that are shown for all asset classes are shown at the top of page 3, and those are the ranges that we have recommended. I think an important addition to this memo this time is right below those boxes, the statement that allocations outside of the ranges outlined above should require prior notification to and approval by the Board of Trustees. So that is in addition to this memo. The paragraph below that...
One second, just so we're clear, that's once we get in these ranges,
That's correct.
right?
That's correct. It will be a working process to get to those ranges, Larry. That's correct. The paragraph below that, just as a reminder, illiquid strategies, private equity, private real estate, opportunistic fixed income, and hedge funds, really, because of their illiquid nature, can't trigger rebalancing ranges. In other words, if you remember back, especially in 2010, where we saw private equity had risen to 10 to 11% of total assets, simply because of the denominator effect of the rest of the assets being marked down, that couldn't trigger automatic rebalancing. So these are really shown as illustrative. The main point in that is that as those asset classes get out of range, the pacing studies and pacing analyses for those asset classes need to be continually remodeled and recalibrated in order to stay within those ranges. The last thing within this context, at the very bottom of page 3, is the allocation range for cash. We talked about this at the November meeting. Generally, we feel the cash should be minimized, again, in order to protect the integrity of the asset allocation policy. But cash is needed for any pension fund, whether it be for benefit payments, funding future allocations, etc. So what we've recommended here at the bottom of page 3, continued on the top of page 4, is that cash be limited to 5% except in unusual circumstances, and cash allocations in excess of 5% should require prior notification to and approval by the board. The last addition within this is the next paragraph, and this was something that we had initially not included in the document simply because we forgot about it.
And it is part of the policy under the previous rebalancing.
Yep. In the current rebalancing policies require that the range of plus or minus 5% to total public equity and total public fixed income. So in addition to the rebalancing ranges that are shown at the top of page 3, an overall governor that total public equity and total public fixed income should remain within plus or minus 5%. We believe that's a valid policy and should be continued.
So the one clarification then is whether the words public are even relevant anymore or whether they should be struck. Because total equity, for example, now includes private equity. And the plus or minus 5%, if you look at the current IPS, actually includes private equity in the total equity bucket.
It does, and we thought about that in that context, and private equity is a very good example of that, Ranji, that again, sort of consistent with what happened in 2010, is that private equity, because of the denominator effect of everything else, ended up at, by itself, almost 5% above target. And we felt that using the private equity in addition to public equity as a trigger to force rebalancing almost forces additional selling of equity and allocation into fixed income.
But that's what we would want, right? So if you get to plus 5%, what we're trying to do is limit the equity risk. And in the asset allocation, we've defined equity risk as including things like private equity.
Understood, except that the vast majority in that scenario, and again, not to say that what happened in 2010 is the model for what would happen again, in that scenario, in 2010, private equity has not been marked down. And yet, public equity at that point had sort of reached its bottom and began to rebound. I think what we wanted to avoid was, if in fact private equity alone is what's driving the over 5%, do you then want to sell additional public equity?
Or just come back to the board and have a discussion. So I don't think nothing here triggers an automatic sale. It just triggers a discussion, right? So the way you
trigger sales.
No, it says you can't do it without prior approval to the board. Staff can come straight back and say, we need your approval.
That's not how these ranges work. I mean, they're sort of I would say it's like...
They are
black
meant to be
boxes.
self-policing, but in
Right.
the extreme example of a 50% decline in the denominator, which is the only environment in which the private equity issue even comes up, this is not a day-to-day issue. Surely, just as you did, we've been outside our investment policy statement in private equity because of the denominator effect in 2008. Nothing triggered any sale. There was a discussion.
I wasn't here. I don't know.
Well, we know from the minutes, and we know from talking to Martin, who was here.
I assume we'll have lots of discussions if the market tanks.
So I think these are,
I'm relaxed about it.
I would remove the word public, because I think it's more meant to capture, as you said, the integrity of the risk rather than the allocations.
Ranjit, then I think the one thing, both to make that sort of consistent with the other allocations then, is that to this statement also, we would also add the provision that in fact should require prior notification to an approval. So in fact, BAM
Yes.
then has the ability to come back and say,
Yes.
hey, look, the reason we're over allocated by 5% to total equity is because of this displacement in the private equity market. We don't think it makes sense to be selling more equity now and get the board
Completely agree.
approval on that.
Completely agree.
I mean, I think as long as that gets added.
As it was historically.
So we're taking out the public.
And adding this, come back to the
The
board.
ability for you to come back to the board here as in the other areas.
Which is pretty much how we've always done it.
Right.
Okay. The last item, number 4, was really the area that I think required quite a bit of additional discussion and work both with the board and with BAM. And we've now come to what I think is a good solution, and in fact one that sort of gets away from the area of you could go this way or you could go that way in terms of which way to allocate assets. So as we say, there really are sort of 4 areas. These would be private equity, real estate, hedge funds, and opportunistic fixed income. It's going to take some time to get up to your total allocation. So the question is, where should you hold assets that ultimately are headed to that? And the idea basically is that we should hold assets for those asset classes in the liquid asset classes that to the best they can most closely resemble the goals and objectives of those illiquid asset classes. So as we've said at past meetings, really for 3 areas, we've had sort of a consistent policy with recommendations to all of our clients. And they're included at the bottom of page 4. Assets ultimately targeted for private equity should be invested in public equity in a manner that reflects the expected global nature of the ultimate commitments. So ultimately, private equity, money that will ultimately go into private equity should be held in public equity. So that means essentially U.S. and non-U.S. equity in some level of proportion to where you expect it to ultimately be invested. Assets targeted for real estate should generally be evenly split between equities, and we've even targeted here potentially including public REITs and fixed income. And that's to reflect the fact that real estate reflects both income as well as equity, and so an allocation of 50-50 to equity, including public REITs and fixed income, makes sense there. And then ultimately, hedge funds, we think generally should be evenly split between global public equity and fixed income, and in this case, global equity, public equity, and core plus 5. So the area of opportunistic fixed income is the one that we spent quite a bit of time talking about.
Do we do REITs here? Please remind me, Martin.
We do not do REITs here, but this is similar to what we adopted in police.
So you'll now need to bring back a toolbox.
We're going to talk about that later.
We'll talk about that later. It's on the agenda.
I can wait. I can definitely wait.
Ultimately, opportunistic fixed income, I think, and we've talked about this at last meetings, the very last bullet on the last page, the last couple of sentences, ultimately Callan in favor and allocations weighted to fixed income over equity, and therefore we're recommending that for opportunistic fixed income, the assets ultimately targeted for there should be held 50% in core plus 5 and 50% in high yield, and that's meant to, as best we can, get to where opportunistic fixed income might best be looked at in your overall asset allocation. This was the harder one to get to, but we think makes the most sense. So ultimately, I think in this memo, we've tried to address all of the areas that we addressed in September and November, stay consistent with where I think there was agreement with the board in the past, and then tried to address the areas that there were still ultimate questions. Be happy to answer any questions.
Larry?
What's the practical implication of your memo? What happens with the adoptions?
Well, for one thing, what it does is really get to the path for how, in fact, you get to your long-term asset allocation that was adopted earlier this year. So for the areas especially, real estate, hedge funds, private equity, and opportunistic fixed income, it lays out where are you going to hold those assets while you look for places for new hedge funds to fund, for new real estate to fund. So that's one part of it. The second part of it is it puts, I think, additional discipline around the asset allocation, the long-term asset allocation you've set for the ranges that, in fact, you as a board are allowing your investment BAM to move within. I think there's been some of that in the past. I think this tightens it up in what will be the policy document to a greater extent.
Would we have to sell assets in order to put them into these buckets that you described for future investment?
Yeah, but that's the rebalancing that they do anyway.
Because it takes we all agreed on what led up to 100%.
Right.
And then you set some plus or minuses around that. This shifts This shifts everything around, sort of pro forma, for something like hedge funds. Let's assume it has 0 and you want to get to 5. Where do you put the money in the middle?
Right.
So if you want to put some in equities and some in fixed income, +2, you shift your ranges over. So it has a very important effect as to how the car gets driven. You've now moved all the bands.
And does that have any impact? Is that a separate allocation from the overall portfolio allocation you have for the rest of it? In other words,
It's shifted everything. So you have your allocation. Take the hedge funds as the easiest.
right.
I think it was fixed income. Let's assume the hedge fund. Let's assume before hedge fund, U.S. equities or global equities is 40%.
Right.
Okay, and you're trying to find, you got 5 to temporarily put. Half of that you're going to put into U.S. equities, so now the 40 is going to be 42.5, and half is going to go into fixed income, so whatever that number was, 20, now it's 20.5. And as you fund out your hedge funds, you sell those. So it's a real shifting of the roadmap as to where the money is at all times.
But it's not shifting it relative to the long-term allocation that has been approved by
That's
the
what I'm
board. It
asking.
is simply
These
getting
buckets
us to
change.
that allocation rather than sitting in cash
Yeah.
if you're moving 15%
Well, I understand.
around.
You don't want to
That's
sit in
it.
cash,
It's
but-
not shifting it beyond that other than allowing for market volatility.
And Larry, I think again, to answer, there's really 2 parts to this. The first, and Larry Schloss put it well, it's to help identify how you get from your old policy, your old asset allocation policy, to the new one you've adopted. So that's one thing that it does. The second thing that it does is help identify, once you are at your new policy, what parameters around that policy you're willing to allow discretion to within market moves, and then identify the moves that we made to get you back to target. So it's meant to impose a level of discipline.
Well, let me come at that question this way.
Okay.
Hypothetically, under your buckets, we should be putting assets ultimately targeted for private equity should be invested in public equity. All right? Okay. So does that mean we take what we have in public equity and we identify a portion of it? This is now what we're earmarked for private equity in the future?
It's just increasing what we already have. This is actually the same, the example that you just picked is no change from the previous, ironically, is no change from the previous policy that we had.
Right.
It simply increases the overall, it increases the entire pie of active, passive in
Your
public
question,
equity.
the answer is yes, not no.
Okay.
Okay. So if we had 5% in private equities, and the target is 7,
Right.
that's 2%.
Right.
You need to put 2% more in your public equities.
And would that 2% allow us to go beyond the range
You
for
just
public
shifted
equity?
your range 2%.
Yes.
We did, so it
Pick the
does
whole
allow
thing.
the range to actually
Yes.
expand.
Yes.
That was my question.
And then as private equity goes up, you can source it from your public equities, as long as you stay within then the shifting ranges. So all those ranges that we go through every month,
Right.
that we keep sort of saying, well, this is the old one, this is the new one, this is how we kind of calculate the new ranges. And every month we tweak it around depending on how we're doing. So if we do 1% opportunistic fixed income, in theory, it's funded from the parking places that we just agreed to in here.
And there are some changes from what was in the past, and I'll use real estate as an example. In the past, I think, in fact, I know, the policy was that any under-allocation in real estate was held entirely in equity.
U.S. equity.
U.S. equity. But now it's recommended here that any of that be held equally in public equity and public fixed income. So it's not all equity.
So when we get a report, we're going to have a report that identifies a certain amount of whatever we have that's eventually targeted for one of these buckets.
I believe that'll be part of what BAM would be
What we're going to do?
working
You're
on.
not going to see, this is the math that goes on behind the scenes for the ranges that you look at every month. Remember these ranges that we,
Yeah, right.
right. All we're saying is to develop the range, it's not as simple as
In the van.
it's putting a band on something that's static, because we have things that we have to move around to get to that. It's all about, since it's not sitting in cash, where do you park it until you get to the
Right, that's
promised
fine,
land?
but will we know that we've got 2% parked in a particular
No,
asset?
no. Once you agree to this, it becomes sort of an algorithm that starts moving it around, right? Because it won't be like, all right, here's the band, and then here's an extra band around it. Because of that, it won't be that specific. It's too hard to pictorially show you.
So I thought you said you would do that at another meeting, Mary, where we would have here's the target, and then here's just how much is, where the target is because of what's parked, because as
We don't
that,
have footnotes.
or just a table, we don't
Yeah.
need a graph,
It's
just
going to have a
table.
footnote that says, you know, this is.
It'll be,
this,
I thought you
is
said it
that.
would be very clear to the board as to how
It will
much
be
is
clear.
the
It will-
target versus how much is parked.
It'll be clear. We'll be back with pretty pictures, clear pictures. I like pictures. Pictures are easy. Well, nothing's wrong.
More questions, Alex?
Yeah. Larry, Mike, with respect to the opportunistic, no, the convertibles, I'm sorry. I can visualize how we go from 1% to 2%. I can't see how we get down to 0. Could you, I mean, wouldn't we, because there's a, for convertibles, there's plus or minus 1. To be out of the range, you would have to be getting at 0 on the bottom end. How would you get to, I don't understand how we'd get to 0. And wouldn't the rebalancing be somewhere other than 0? Shouldn't it be somewhere other than 0?
Well, you're talking about a range that's only, you're talking about a policy that's only 1% to begin with. And so to have a range,
Well, the only way you could get to 0 is by selling it. So that wouldn't make any sense, right?
well, no, because you'd be selling any other asset class if it would be above or below or within the target.
No. To get to 0. To get to 0, you would have to sell everything, which means you would have to rebalance and buy it back. So what I'm saying is that conceptually, that doesn't make any sense.
Well, no, because within each of the other rebalancing ranges, it would be the same potential buying and selling
How would you get to 0 in the convertibles?
if you were to sell the existing assets. But that's no
But then
different
you
than...
have to turn right around and rebalance, because you're at 0, right?
Well, I think the reason it's in here as this is that we, in fact, did not model convertibles as part of our asset allocation. At a de minimis amount of a 1% allocation, that's not something we typically allocate for in our long-term strategic. I think there was a board decision to invest in convertibles at a level of 1% and have that within a carve-out. So I think practically the decision not to have any convertibles, or to be down to zero in convertibles, would be from a decision to be out of convertibles, period. Which would be at the, I'm not sure what the decision on that would be, but you know, unless the convertibles lost all their money, then it would
So
just be a
if you
decision to
sold
be
them down
out.
to zero, you would just change, you wouldn't be following this rebalancing requirement.
Yeah, and again, this I think is sort of outside of the rest of the rebalancing. What we're saying here is, although we didn't model for it, we're comfortable with an allocation of 1% convertibles in core plus 5, and a range around that. If you had nothing, then that wouldn't impact our asset allocation work. If you went up to 2%, that would be okay also, but I think those are the ranges that we feel comfortable
And
with.
also, we start getting past 2%, you start getting into capacity issues with some of the managers.
Right. But I mean, it was the same for opportunistic. The
Opportunistic is, by definition,
minus
it's
5.
opportunistic. Yeah.
Right.
It's,
But we got a 5% allocation. The minimum before you have to rebalance is 0.
that's because there may be some times where the opportunities aren't there, and as you know from our discussions about, without getting into individual managers, but as far as the policy goes, if the opportunities aren't there, we're encouraging our strategic partners to return the capital so we can employ them or deploy them where the returns are, and they can then call the capital back when the opportunities are there. That's different from the other asset classes.
Okay, do we have a motion to accept Callan and Van's recommendations on rebalancing for the Callan memo? Second?
Second.
All in favor? Any opposed? Motion carries. Can I also get a motion then to leave public session and go into executive session? Any opposed? All right, we're in executive.